Hey, welcome back. Today we are getting straight to it and building out your investment playbook for the next couple of years. So if you've been asking yourself, where should I put my money in 2026 and 2027? Well, you are in exactly the right place. Let's dive in. This is the million-dollar question, isn't it? It's on every investor's mind right now. With the economy shifting under our feet, where are the real returns going to be? Are we talking about something solid you can touch, like real estate, or the classic growth machine of the stock market? Or maybe it's time to fall back on the age-old safety of precious metals. We are going to break down what the analysts are projecting for all three. So let's frame this up. We've got three heavyweights stepping into the ring today. In one corner, you have the momentum and safety of precious metals. In another, the compounding power of stocks. And in the third, the tangible stability of real estate. Each one has a really different story to tell for the coming years, and we're going to dig into the case for each one. First up, let's talk precious metals. Now, historically, these are seen as the ultimate hedge, right? Your safe harbor in a storm of chaos and inflation. But the forecast for 2026, it's about a lot more than just playing defense. We're talking about some serious momentum. And just look at this number, $5,000 an ounce. Just let that sink in for a second. Major players like JP Morgan are forecasting that gold could blow past this mark. Now, this isn't some wild guess from the fringes. This is a seriously bullish case coming straight from the heart of the financial world. So, what on earth could be driving a move like that? Well, it really boils down to what you could call a perfect storm of factors. You've got central banks all over the world buying up gold at a pace we haven't seen in decades. You turn on the news and there's constant geopolitical instability, which always makes gold look like that critical safe haven asset. And then there's silver, gold's more dynamic sibling. It has this huge and growing industrial demand. We're talking solar panels, EVs, you name it, and that creates a totally unique pull on its price. Okay, so here's how to think about it. Gold is like the anchor for your portfolio, right? It's the hedge against all that uncertainty. Silver, on the other hand, that's your high-octane opportunity. Analysts call it a high beta play, which is just a fancy way of saying its price tends to swing way more dramatically than the market. So when things go up, it could actually outperform gold in percentage terms. It's really for investors who want a shot at aggressive gains on top of that core safety. All right, let's shift gears and talk about the traditional engine of creating wealth, stocks. If precious metals are all about protection and momentum, equities or stocks are all about that beautiful long-term compounding growth. And the outlook here is looking really strong. Projections from big firms like Goldman Sachs are pointing toward double-digit returns, somewhere in the ballpark of 11, maybe even 12% for global stocks in 2026. After the roller coaster we've been on, that's an incredibly healthy forecast. And what's really important here is that this projected growth isn't just based on speculative hype or wishful thinking. No, it's based on real, solid corporate earnings. It's being powered by two massive forces. First, the widespread adoption of AI, which is boosting productivity across the board. And second, what economists are calling a mid-cycle acceleration in the global economy. Basically, things are heating up again. So the verdict on stocks is pretty clear. For any investor whose main focus is long-term capital appreciation, really growing that nest egg over time, stocks are still the number one vehicle, especially in areas like technology and diversified global funds that are set to capture this broad wave of growth. And that brings us to our third and final contender, real estate. Look, after a few wild years of crazy price swings and painfully high interest rates, the story for 2026 isn't about another boom. Not at all. Instead, what we're looking at is a steady, confident rebound. So instead of those explosive gains, we're looking at moderate, sustainable price appreciation. Think somewhere in that 3 to 5% range annually for most mature markets. Now, this isn't the chaotic boom and bust cycle we've seen in the past. This is a welcome return to stability and fundamentals. So what's actually making this happen? It's really two key things. First, interest rates are finally expected to stabilize or maybe even decline a bit, which makes mortgages more affordable for everyone. And second, there's a huge amount of what they call pent-up demand. Think of all the potential buyers who've just been sitting on the sidelines waiting for the right moment. Well, they're expected to jump back into the market in a big way. So the main takeaway here is that real estate is really a recovery investment for 2026. It's best for people who are seeking the stability of a tangible asset, something you can actually see and touch, plus the unique power of leverage that property gives you. It's a strategy that's focused squarely on capitalizing on this market turning the corner. Okay, so we've looked at all three contenders on their own, but their real magic, the secret sauce, isn't just about picking one winner. No, it's about understanding how these pieces fit together to build a portfolio that is perfect for you. This quote really gets right to the heart of it. There is no single best investment that works for everybody. It all comes down to your personal goals and, maybe more importantly, your tolerance for risk. Are you trying to play offense and go for aggressive growth, or are you playing defense with a focus on stability and steady recovery? Let's put this all together and look at them side by side. If we look at the primary goal, you've got protection from metals, growth from stocks, and stability from real estate. How about the outlook? It's bullish for metals, positive for stocks, and recovering for real estate. And notice this, the key drivers are completely different for each one. Geopolitics for gold, corporate earnings for stocks, interest rates for real estate. Seeing it all laid out like this really makes their distinct roles in a portfolio crystal clear. So with all that in mind, it kind of leads us to two potential playbooks. Over on the left, you've got the aggressive portfolio. Here, you lean heavily into stocks for that core growth, and then you'd add a dose of silver for that speculative high beta upside. Then on the right, you've got the defensive portfolio. With this strategy, you'd overweight gold for that bulletproof safety and add real estate to capture that tangible asset recovery. Which one of those sounds more like you? In the end, it all boils down to this single question. As we look ahead to 2026 and 2027, the strategies are becoming clear, and the opportunities are definitely there across these very different asset classes. The playbook is right here in your hands. So the real question you have to ask yourself is, are you going to play offense or are you going to play defense?